Precious metals bull markets are led by gold. They're led by the fear buyer. The lower unit price of silver usually causes the generalist investor to concentrate his or her purchases in silver rather than gold. It wouldn't surprise me to see higher U.S. interest rates keep gold soft or even cause it to decline for the balance of 2026. The big thinkers in the world have suggested that we'll use less auto catalysts in the future because they believe the internal combustion engine is going the way of the dodo. What I like personally about investing in gold rather than real estate is that real estate investing is a business. You have to add value. I don't have to add value to my gold. I split my savings assets between bullion, the US dollar, and a couple other currencies. A carefully chosen portfolio of higher quality silver stocks will do extremely well. I think, and my former partner Eric Sprott has proven it, there's even more money to be made if you can stomach the risk and the volatility in low-quality silver stocks. Money is made on the delta between price and value. In bull markets, value gets more expensive, which is bad.
Some people are beginning to get excited about gold. And knowing Ulrich, I know that you're probably less excited now because you like hate. You like when assets are unloved and there's not a lot of attention on them. So would I be correct with that assumption? And what's your outlook for the precious metal sector?
Well, I think that's correct, Vlad. As you know, I've failed retirement completely, and the consequence is that I still have income that's beyond my needs, and I save the delta between what I earn and what I spend, and I save it in gold. The consequence of that is that it's an item I want to buy. And if there's an item you want to buy, you don't want to see it increase in price. Of course, it makes me feel nominally better that the purchasing power of the gold that I have in my portfolio increases. But the truth is, from here, it would require substantially higher gold prices to get me to sell. And I'm content to buy at current levels. So my own interest is served by lower rather than higher gold prices. It's important when you put that statement in context that I'm expecting that the gold price, at least in nominal terms, in US dollar quoted terms, does very well in the next 10 years, but maybe not in the next 10 weeks. It wouldn't surprise me to see higher US interest rates keep gold soft or even cause it to decline for the balance of 2026.
Gold can look safest precisely when investors should be most selective about buying it. As Rick Rule notes, his willingness to buy at current prices reflects a decades-long view, not headline chasing. The overlooked signal is his expectation that higher US rates could pressure gold through 2026, even while dollar purchasing power deteriorates. For wealth protectors, volatility may create better entry points. Next, Rick Rule exposes why short-term gold weakness could strengthen the monetary case.
Looking longer, all of the earlier conversations that you and I have had in these interviews about the fact that I believe as a consequence of debt and deficits that the purchasing power of the US dollar declines substantially over 10 years means I'm extremely confident in the long-term outlook for gold. And for me personally, despite the fact that I'm 73 years of age, the near-term price of gold is of no concern to me.
Right. And do you really have any thoughts on silver right now, or do you still see it pretty much following gold, whatever gold does?
In my experience, precious metals bull markets are led by gold. They're led by the fear buyer. When the increase in the gold price makes the precious metals narrative of interest to the generalist investor, and the generalist investor comes into our little precious metals ghetto, the lower unit price of silver usually causes the generalist investor to concentrate his or her purchases in silver rather than gold, and silver then begins to outpace gold. This traditionally has taken place fairly late in both secular and cyclical precious metals markets.
Yes, and what about platinum, Rick? People don't talk as much as about platinum as they do about gold and silver, but it has a lot of interesting fundamentals as well, right?
The principal fundamentals for me are three. One you touched on, people aren't talking about it, and I like assets out of the mainstream. But there are two more. The first is that platinum and palladium are critical components in autocatalysts.
Gold may be the headline, but silver's biggest move often begins after investors finally believe the story. According to Rick Rule, precious metals bull markets are typically led by gold before investors rotate toward cheaper silver, amplifying momentum. That sequence matters because late-stage enthusiasm creates opportunity and risk, while platinum remains ignored despite supply vulnerabilities. For investors, being early matters more than chasing confirmation. Next, Rick Rule unravels why platinum's neglected supply chain could surprise markets.
The big thinkers in the world have suggested that we'll use less autocatalysts in the future because they believe the internal combustion engine is going the way of the dodo. I think that's wrong. I think we'll continue to require autocatalysts for cars and for all matter of energy generation from fossil fuels. But supply is also an issue. Most PGMs in the world are produced in 3 countries, South Africa, Zimbabwe, and Russia. And the potential for supply disruptions, social chaos in all 3 of those countries, I would suggest to you is relatively high. I'm not saying we're going to see a breakdown in any of those 3 countries, but should we do so, the demand for platinum would continue unabated, but the supply would decline dramatically, leaving in place the possibility, not the probability, of very rapid price increases.
Right, yes. I have been actually getting, Rick, some questions from my friends about precious metal sector. They have been asking, well, should I get into the gold sector right now? And my answer is really like, what's the alternative? When I look at prices of real estate in America, they're really high, right? The young people cannot afford it. It's very difficult, etc. But if you measure that in gold, it's actually pretty much as cheap as it was in 1970s, which again, proves the point that, well, you don't see much alternative saying not saving in gold.
The real estate business has been good to me, and you make an interesting analogy.
Platinum could become more valuable precisely because markets assume its demand is disappearing. What Rick Rule is highlighting is supply concentration, not optimistic demand forecasts, with most PGMs coming from just 3 countries. Any disruption could create asymmetric upside even without explosive demand growth, while expensive real estate looks different when measured against gold. For wealth preservation, nominal prices can hide declining purchasing power. Next, Rick Rule exposes why owning gold may be less burdensome than owning property.
What I like personally about investing in gold rather than real estate is that real estate investing is a business. You have to add value. I don't have to add value to my gold. I throw it in a safe deposit box and let it do what it does. When I was a younger man and I would buy duplexes and triplexes and stuff like that, it was an active business. Now, for 40 years of my life, until 2022, 2023, real interest rates were falling. That was wind in the sails in the real estate business. Now that interest rates are rising, it's a little less certain. So I personally, one is a consequence of the fact that I'm 73 years of age and I would prefer to do less rather than more. But also because real estate has become such a popular sector, it is easier for me to store my wealth in gold than it is to store my wealth in duplexes or triplexes or other forms of developed real estate. Now, for those people who listen to you, who have the ability to add value in real estate, for those people who have the ability to buy a building that isn't living up to its potential and fix it themselves, there's no better asset class on the planet. I don't happen to be one of those. Warren Buffett once said he, as he became older, became more attracted to investments that required of him sloth and lethargy. And I agree with that assessment.
Real estate can look like a safe store of wealth until rising rates turn ownership into an operating business. Rick Rule's argument suggests the real advantage of gold is its simplicity. It requires no tenants, renovations, leverage, or constant management to preserve value. Falling real rates once supported property valuations, but that tailwind has weakened as borrowing costs rise. For older investors, simplicity itself becomes a portfolio advantage. Next, Rick Rule reveals why silver mining leverage can transform quality into a secondary consideration.
If we look at the silver side and these, maybe slightly less quality producers than the ones you mentioned, like Pan American Silver, Fresnillo, do you think there could be an opportunity in those companies as well?
I think it depends on your time frame. I think there's 100% certainty in the 5 to 6 year time frame that a carefully chosen portfolio of higher quality silver stocks will do extremely well. I think, and my former partner Eric Sprott has proven it, there's even more money to be made if you can stomach the risk and the volatility in low quality silver stocks. Paradoxically, the low quality ones do better in a bull market than the high quality ones because they get better margin expansion. Most people can't stomach the risk and the volatility to participate in the crummy silver stocks. I can't do it because it's inelegant. These are businesses that are usually selling relative to the quality of their earnings at premiums to companies that seem more expensive, but they certainly offer more leverage. And for some silver speculators, Eric Sprott, particularly among them, perhaps the most successful of that ilk, leverage to the silver price is the key speculative attribute that they look for. I'm not one of those. I'm more drawn to quality.
Right. When I read some of the comments, I noticed that people can be quite emotional.
Silver miners can offer enormous upside, but the companies with the most leverage can also deliver brutal drawdowns. This is where Rick Rule's thesis shifts toward time horizon, because 5 to 6 years can separate disciplined investors from speculators chasing immediate gains. Lower quality miners may outperform when margins expand rapidly, yet that leverage cuts both ways when silver weakens. The portfolio lesson is simple. Upside is never free. Next, Rick Rule exposes why investor psychology can destroy even the strongest commodity thesis.
So if they hear an opinion that does not combine with what they think, they get angry and things like that. So do you have an advice for people on how they could control emotions in these very volatile markets? Would it be as simple
No,
as...
no. I've looked at that for 50 years and I've taken to commenting occasionally to people's social media posts, just asking them to consider getting a life. But I think there's a lot of basically unhappy people, and they broadcast their unhappiness in whatever sector they happen to inhabit. I'm a basically happy person. And with the exception of government and taxes, I try to be cheerful about everything.
Yes, if you look at it from investing side, or when prices goes up, people get excited, they want to buy, pretty much doing exactly the opposite what one should likely do. How do you manage your emotions? Is it as simple as writing the reasons why you bought the stock and being very structured about it?
Yeah, absolutely. I mean, I believe that money is made on the delta between price and value. In bull markets, value gets more expensive, which is bad. In bear markets, value gets cheap, which is good. Um, it's interesting that people, when they buy consumer goods, often do well. There will be consumers that will spend 15 hours buying a car, or 4 hours buying a coat, or will spend 10 minutes in a grocery store looking at the calorie count or the expiration date on groceries. But when it comes to stock, it's got a hunch bet a bunch. That makes no sense. It, Many people, if there's a stock that goes from $2 to $4 with nothing changing, get excited by the price momentum. If they went to the store and they bought a can of tuna fish for $2 and 2 weeks later it was at $4, they'd be outraged. The truth is, if people bought stocks the way they buy tuna fish, more people would make more money.
Investors often spend hours comparing everyday purchases while buying stocks with nothing more than a hunch. According to Rick Rule, the real edge comes from understanding value before price moves, then acting rationally when markets disagree. A stock doubling without improving fundamentals should trigger scrutiny, not excitement, because momentum can disguise deteriorating valuation. For savers, emotional buying turns temporary enthusiasm into permanent losses. Next, Rick Rule unravels why liquidity can matter more than being perfectly positioned.
One other important factor to cover is the importance of liquidity and cash, because we know that all of these sectors, even though they're, slightly independent, they very much depend on the stock market. If stock market have experienced a crash or a huge liquidity event, well, everything will go down. And in that situation, people who have their own liquidity could benefit from the opportunity. So if we could talk about that if possible.
That's absolutely right. It's odd. Um, I try to explain to people that maintaining liquidity has a cost. If you're an American investor and you buy the US 10-year Treasury, you're getting paid now 4.6 or 4.7. A return that viewed from historical returns is fairly attractive. The difficulty from my point of view is that the purchasing power of the US dollar is declining at 8% compounded. So you're not actually making 4.7, you're losing 3.3. Viewed in that lens, one would want to save, at least in liquidity, as little as possible. But I regard that 3.3% negative yield as an option premium. Having the cash in a liquidity-driven crisis, say a 2008 style crisis, would give you the tools and perhaps the courage to take advantage of it. 2009 being the best investing year of my career. I'm not saying that there's a probability of a stock market crash. I'm not one of these guys who say, the world's going to fall apart around us and right away. What I'm suggesting is that there is a possibility of a liquidity-driven crash.
Cash looks unproductive until markets suddenly become desperate for it. Rick Rule notes that liquidity can function like an option premium, sacrificing some real return today for the ability to buy during forced selling. A 2008 style shock would punish investors who are fully invested and leave them without flexibility when valuations collapse. For wealth preservation, dry powder is not a crash forecast. It is insurance against opportunity. Next, Rick Rule exposes why gold and cash serve different purposes.
And if that occurs, the return that will accrue to people who have a lot of liquidity will be similar to the returns that accrued in 2009, which was the best single investment year of my career. What I've learned about cash, and gold for that matter, is that it helps me sleep nights and stay calm. And I split my savings assets between bullion, the US dollar, and a couple other currencies. I maintain my liquidity in currencies that I'm likely to use as an investor or as a traveler and citizen. And I save the bulk of my excess income in gold.
If I could ask you this question, Rick, would there be any sectors at the moment that you believe is overlooked, maybe cheap or attractive that you like?
Nothing is cheap. There's no hate, except there is hate for places, for people who can afford to speculate. You do need to take risk if you're willing to be a geographically contrarian investor. Sudan has made me money. Congo has made me money. The truth is that there's a lot of money to be made speculating. If you're rational, after the flak jackets have come off, but before the currency is convertible. If you're really aggressive, like I was in the Congo in 1996, you invest when the flak jacket is still on. As the Rothschilds would say, literally, when there's blood in the streets. So the only form of investing I can say where true hate-based contrarian investing is still live and lively is geographic rather than by commodities.
Nothing looks cheap when investors demand certainty, but extreme geographic fear can create discounts commodities alone cannot. What Rick Rule is highlighting is that contrarian opportunities sometimes appear where political and currency risks have already crushed expectations. That strategy is not conservative. It requires accepting genuine instability before conditions normalize. For most investors, the broader lesson is powerful. Fear can create value, but only when risk is understood. Next, Rick Rule reveals why patience, not prediction, becomes the ultimate advantage.
Yeah. So unfortunately, we are running out of time, Rick. Is there anything else that you believe is important that we haven't mentioned yet?
Vlad, I've for free, evaluated almost 100,000 portfolios, I've told, in 30 years. And while I've taught a lot, I've learned a lot too. I've learned that most speculators don't have enough patience. The great miracle in finance is compounding. And if you're a short-term trader, you obviate your most important advantage, which is to say time. Most speculators can't help themselves. They're not contrarian. Most investors are not tenacious. And I think that's because most investors don't work hard enough. If you focus on the fact that money is made on the delta between price and value, you need to work hard enough to establish what you think is a reasonable valuation in your mind. If you do that and the price of a security falls, you're more inclined to be a buyer than a seller. Most investors can't do that. Most investors, when they see the price of a stock at $1, have no estimation of what its value is. The consequence of that is that when the stock goes up, that reinforces a narrative that has no basis in fact, and people like it. When a stock goes down, it shakes the narrative and they sell it. In other words, they characteristically overpay. And that's a very bad thing. I believe that the number of stocks that you should have in your portfolio should be concurrent with the number of hours per month you're willing to spend studying those stocks.
Most investors think diversification means owning more stocks, but that can quietly eliminate the time needed to understand any of them. This is where Rick Rule's thesis shifts toward research-driven concentration, where portfolio size reflects actual analytical effort. His experience evaluating nearly 100,000 portfolios reinforces a brutal reality. Without valuation discipline, rising prices create false confidence, while falling prices trigger panic. For serious investors, ignorance disguised as diversification is dangerous. Next, Rick Rule exposes the research standard most portfolios ignore.
10 hours a month, 10 stocks. And when I say studying the stocks, I don't mean listening to Rick Rule or Vladislav videos, although I think that's a good thing to do too. I mean reading annual reports, quarterly reports, proxies, resource statements, insider filing statements. What I find is that a whole bunch of people have 40 or 50 or 60 stocks in their portfolio and they work 2 hours a month studying them. And that doesn't work. That's an investment technique that Doug Casey describes as, quote, got a hunch, bet a bunch.
Owning 60 stocks while studying each for minutes is not diversification. It is outsourced conviction. Rick Rule notes that genuine research means reading filings, reports, resource statements, and insider disclosures rather than consuming commentary alone. His 10 hours for 10 stocks framework forces investors to match portfolio complexity with actual attention. That matters because neglected holdings can hide risks long before headlines expose them.